That's the beauty about this stuff, because we are just talking about what's going on in the industry, about venture capital, about startups, about
Yeah.
careers. Well, with careers, it's usually a challenge because we need to pass it through PR for approval.
Yeah.
But we can start with the hat. I love the way that you carry your swag.
Oh, thank you. Yes, I'm very on brand today. So
Good job. Good
thank
job.
you.
I appreciate it. And I appreciate also the background. Now, is that a real background or is that just like a nice slide? Because usually you will have like American family behind you.
Yes, no, I know. No, this is my actual house. So you're seeing the real deal.
This is not my actually house. I'm just renting. My usually house, well, you can check out other episode to see the background of my real house. This is not the case. So how about we'll do a little bit of background because you
Yeah.
spent also like 4 years here in Boston.
Yeah, I
What
did.
brought you to Boston and then what brought you to American Family Ventures?
Yeah. So prior to Boston, I had a career in engineering. I was a mechanical engineer. I was doing medical devices.
Oh,
So
I'm so
still,
sorry.
I know, me too. Me too. It was terrible. I am extremely extroverted. Engineers usually are not. And
Mhm.
I like fast moving environments, and manufacturing in regulated spaces is not that. So knew that wasn't going to be a fit long term.
So
Uh,
you shifted to insurance, which is not
I
regulated at all.
It was an evolution. So
Okay, okay.
the first gear change was, all
Mhm.
right, what do I want to do? And I realized I want to be in tech venture capital. And so I looked around, and there's like not one path or a couple credible paths to get in, but I did see a commonality was a lot of people had Stanford or Harvard MBAs. So I found myself at Harvard Business School, which is what brought us to Boston. And was up there for 4 years, moved up a little bit ahead of a matriculation because I did a venture internship in the city with a family office there, and then stayed working at a fund in Boston for a year after school. So net was there about 4 years.
And when was the leap to AmFam Ventures?
Yeah, so I started my career after HBS in
Mhm.
enterprise, like B2B enterprise software investing. And, when I kind of zoomed out, one of the things that I've always struggled with venture capital is that there's not a lot of differentiation in terms of like the dollars. You've got a lot of funds with a lot of dollars, and everybody tries to make some pitch as to how they're differentiated and yada yada.
We
But
are
at the end of the
smart
day,
money.
exactly.
I
Oh my gosh.
smart money. We guide entrepreneurs. This is our added value. You should take
Oh yeah.
our money.
I
Now,
just
having
like call
said that,
hogwash on all that. I just call hogwash. So, but
we'll,
what I
we'll, we'll get back to that.
we'll get
Okay.
back to that. But what I do think is real and tangible is like when you kind of are able to hone in and focus and build expertise in certain vectors. And so that was not a perspective I had when I first joined venture capital. It was one I grew after really my first year in VC. I was like, my fund was trying to raise. They weren't successful at raising, which is why I ended up leaving. But like I was listening to their pitches, and I was like, this has got to be an identical pitch. Like your pitch could be this other fund's pitch. And like, I'm sure that other fund has the same pitch as you.
Yeah, yeah.
So like, I'm sure returns are a way to differentiate, as well as like, you need to have like people with access advantage or some sort of differentiation that you can hang your shingle on. And I thought that was, let's build alpha through expertise. So my next move was into fintech investing. So I was like, all right, fintech feels like an up and coming vector, let's give it a whirl. Worked at Safeguard Scientifics, which is a publicly traded venture capital fund. We can talk about why being a publicly traded venture capital fund is a terrible idea.
Wait. What do you
Yeah,
think about evergreens?
I'm not that familiar. Oh, evergreen funds.
Yes.
Oh, I think evergreen funds are great. I love a good evergreen fund. I think they can be hard at times because you really need to it's really hard to know your exits. So I think you always need to have that liquidity because exits can take, we say a fund life is 10 years, but it's really like 15 years and you don't know when exits are coming. So I think evergreen funds can be good. And I think you have a different type of investment strategy when you're going after evergreens. It is different than an institutional fund.
Great. So you answered the question. I was about to say, hey, when we talk about the public, when we talk about the evergreen, because there isn't really an exit strategy because it's evergreen, and it completely changes who are your LPs and what's their expectation. But we can go back to that if we'll go back to that.
Yeah.
Now, we were talking about...
I think that before we move on from that, just real quick, what I think is cool about that is that there's a lot of companies that have a lot of merit. They've built something real, and traditional VCs are just like, pass. Like, you can't get me to that $100 billion, exit. And really like $1 billion exit. But like in recent years, we've been talking about $100 billion exits, which is just wild. And so to me, it's always been like, okay, evergreen funds are a little bit more of the realists where they're like, this company has downside protection. Like, it's not going to zero. It's also not going to $1 billion, but I can make money if I play smart here. And then it's just about managing it through its life cycle. And so that's not a terrible strategy.
Not at all. And listen, I'm getting more and more into that because nowadays in my role as an investment banker, that's more or less my job.
Right.
Okay. We were in the middle of your journey.
Oh, okay. Yeah. So FinTech fund, and then AmFam was was hiring. And what I found really interesting about AmFam is that at the time they were a corporate fund that was poised to spin out. That was the whole bet that I was making, was that, hey, I can be an early individual at a fund that's just getting established as an institutional fund. If they're able to pull that off, man, oh man, couldn't that be a cool place to be? And I loved that it was also further specialization within the fintech sector. And I was cautious in that I love the InsurTech asset class. I do think it's large, but I think to be able to play in insurance, you need to be able to play in categories that are adjacent to insurance. And so what I really liked about AmFam is that I would be able to have this insurance specialization, but I would also still be able to do broader fintech companies. And I was able to actually build out our prop tech practice, which is, things in and around property technology. So,
It works well together. And this is, if we are going back to, Jay Weintraub and Caribou, they started with InsurTech Connect, and beside now 5 other different conferences, one of the first one that they sprung out or spinned out was Blueprint, which is PropTech, and it's also just spot on the road because it completely makes sense. Hey, that's one of the biggest assets, class assets that we have, real estate, and makes sense.
And if you think about what insurance companies really are, is they're asset managers, and asset managers have a lot of real estate holdings. And so it just makes a lot of sense in the way to be able to track how those markets are moving, because they have a true impact on the insurance ecosystem.
Cool. So now you're with AmFam Ventures, and because I mentioned ITC, and I'm sure that we're all going to meet there in what we are recording September 20. So it's in a month and a little bit. And talk with that a few times with Bill. It's like, you guys pushed everything, and including Dia Munich. And as a result, there is no Oktoberfest this year for us. But it's all about, can you find a good location? And that's basically what shifts everything around. And going back to AmFam Ventures, at ITC, and that's been a tradition, you guys usually host the best party.
Oh,
now, is that going to, previously, as a starving entrepreneur, we were always waiting, okay, we are going to eat at the AmFam Ventures.
Yes, you will.
That's where we're actually going to eat, because all the other, it's like drinks, a little bit of food. But I think that I was still a founder then, And that was with, you did an event with Propel
With
Ventures.
Bull Penguin.
That
Yep.
no, Bold Penguin always.
Oh,
Bold
okay.
Penguin. Ilya, love you, but we are not talking about you, Ilya. No, it was with Propel Ventures. I think that was
Oh, yes.
the 2017 or 2018,
Yes.
something like that. So that's kind of brand to my memory as this is where I eat. But
Excellent.
going back to reality, so nowadays you are kind of in fund two and opened up to new LPs. So it's not, correct me, yes,
Yeah,
no,
yeah. So like kind of. We're in
kind of.
fund four.
Oh,
So
sorry.
that's the
Ooh,
kind of that's all right. Don't worry.
yeah.
But I like it kind of is fund two in if you're talking about like our institutional funds. So it's our second institutional fund. Because we had the corporate fund was on balance sheet, then we had a like single LP fund, and then we've had two institutional funds. So we
Mm-hmm.
just announced, which is really exciting, Fund 4, which is $444 million. So now we are very well capitalized, which actually I'm like really excited about because, I mean, in general, that's a sizable amount of money. And like also then, kind of knock on wood, but good luck to us for returning that, sizable
Yeah.
amount. That means you have to have sizable returns. But when you kind of zoom out, I think that like, venture is an ecosystem of being contrarian, and it made
Ooh,
a
that's
ton
a
of
good one.
sense. Sorry.
That's a good phrase. Yeah.
Yeah, yeah. And it made a lot of sense to be like raising funds in 2020, right? When like everybody was raising funds and like it was,
Mm-hmm.
sprinkling it. But I actually think the 2020 vintages are going to be terrible because everything was overpriced. You had to be deploying your capital. And so we were really lucky in that we raised in 19. So we were able to like kind of be cautious about how we were deploying in 20. It's still close to 2020. But like the fund's doing really nicely. And then we were able to, now raise again in like, closing the fund in 23. And in doing so, I think we're like at like everything's on sale right now, right? It is a really good time to have dollars in the bank to deploy them because I think this vintage year, they're going to be really good vintages.
And here's the point, and that's very important to the founders who are listening to
Yeah.
that, is understand where the VC, which fund they are investing in, and
Yeah.
at what year it is. Is it still fundraising? Are they investing from the previous fund? Is it just a catch up? Are they actually rolling the previous fund to the current fund? Because that completely changes, let's call it the attitude. Now, you skipped a few years there because you know that
Yeah.
we are about to finish 2023, right? So
Yeah.
it was
Yeah.
2020,
Yeah.
then
Oh, and then we didn't
everything
raise
went
again.
up,
Like we raised, it
then
was
it's like
2020.
dead.
Yeah. Well, 2020, 21, it was like overinflated. 22 was
Yeah.
this like bleak time where everybody was like, oh no, we need to re-gear, we need to retool. And then 23, I feel like the thing that really annoyed me about the 2021 cycle is that, like, well, a couple of things. First, we like haven't had a bear market in a long time. So it was
Yeah.
extremely disorienting. Like I joined the venture capital world in 2015 and it's just
Hmm.
been this steady climb to the right where valuations have gone up, round sizes have gone up, fund sizes have gone up. And so you're trying to figure out, am I good at this? And like there's a lot more noise than typical because you're like, all right, the companies are doing well, but they're doing well because the market's doing so well. What happens when the market's not doing well? Do these companies still do well? Do they have solid business fundamentals? And so for me in my own personal underwriting, that has always been a really important factor is understanding, could this business stand on its own merits without having access to an obscene amount of capital? Because capital was just a commodity over the last couple of years. It was just there. Everybody just relied on it like, oh, don't worry, I can burn money like it's going out of business because, there's more money to be had. And now we're definitely not in that cycle. Everything has contracted. Cash
Hmm.
is not a commodity anymore. And I think what you're starting to see is that the really undisciplined founders who didn't build their business off of sturdy, like solid foundations of like really good unit economics and just understood why contribution margin was so important, they're really struggling because it's really hard to build that on the fly versus just pare back a business and maybe pare back growth to get to more reasonable state, leaning on your sturdy foundation. And those are the businesses that have been really successful in weathering this storm. And I totally believe that the companies that are coming through their seeds and Series A's right now, it's like trial by fire a little bit. Like you're getting that ingrained into you because to raise right now, you need to exhibit that. And so it's just reinserting discipline into the ecosystem, which we haven't had in such a long time. So for me, I'm like, finally a breath of fresh air because it feels like we're reverting back to, you know, fundamentals that are logical that you can predict a little bit versus the last couple of years just felt like, all right, this is a gamble. Like we'll see, like, you know, heads or tails, let's flip coins.
That's a horrible thing to say because it's very calculated and there is a proper due diligence and no one is just gambling on startups because they like or may not like the team.
No, never gambling.
Never at all. Never at all. So, and I cannot say that as of course, proper, there is a process. Now, so let me stop this momentum and a lot of energy and we'll just do a little bit of technical stuff so people can kind of think and speculate about, you know, based on the fourth fund, which I think that if you say 440, I think it's actually bigger than the Munich Re-Ventures fund that they announced. So you're the biggest one in the field. I think, I'm not sure, but maybe. What's the size of the team? How many partners?
We have 13 investors.
13 investors. Wow, that's a big one.
Yeah.
How many portfolio companies?
Oh, actually, you're catching me flat-footed here. I'm not sure of the total portfolio. I think like overall across all the funds, it's like 60 something. If we're talking about, you know, the last couple, it's obviously much smaller than that.
Yeah, especially in the past 2 years, which were a little bit more challenging.
Yeah.
And usually you guys invest in...
It might be 90 if you include Fund 1, which had a lot of checks sprinkled in. So if you don't include Fund 1, I think it's like 65. But yeah.
Well, I remember a conversation with Asaf one back in, it's like, oh, you should meet Peter and talk to him because, you know,
he'll just write a check.
He will write a check. It's like, you need to solve him a problem, and that's a problem that you need to solve him. And there, of course, I was like, no. I have a different problem that I need to solve that I want. And I will not talk about ball penguin and that problem that, in hindsight, I should have maybe moved to the... but that's a different story. Going back to AmFam Ventures, there is a team, size of checks, and when do you invest?
Size of checks, we do everything from kind of like $500K, and on the upper end, we'll cut like a $10 million initial check. We invest from everything from pre-seed or like actually incubation all the way typically through the Series B. So we can write checks, first checks kind of anywhere in that window. Technically, we can go later if we want. It's just we're an early stage fund, and I think we need to stay true to those roots. And so when you're going later and later, unless you're getting some sort of killer deal on a recap situation or some interesting in that you have, usually those are two later stage evaluations to really drive our early stage kind of targets, return targets.
And I assume with that, there are going to be follow-ups.
Yes, absolutely. Yeah. We reserve basically about half the fund for follow-ons.
Oh, fantastic.
Yeah.
I think that's the basics so people can understand that, oh my God, from $500,000 to that, from pre-seed and incubation all the way to B, C, maybe even D as part of the follow.
Right. I think the only other thing is like, do we lead or follow? And we'll do both. So you can just count us in.
Oh, cool. No problem. We'll talk about it when we are stop recording. Cool. Great. So, should we talk who's your most favorite startup?
Oh, that's like
Ooh.
asking a parent what's their favorite child. I don't know
And
if
you
you can.
know that, and you know that there is the one that will be successful and the one that you will need to help throughout his life, her life,
Yes,
basically.
yeah.
Yeah.
Maybe, yeah. I had never thought about it in that framework, but I guess that's right. So look, I think that we have a couple that are
No need to
really,
name
really
names. No need to name names, right?
okay. Okay.
But you can describe them so we can understand more about the problem and when or why
Yeah.
a VC can actually help without naming names of that specific type of startup. And it's more about why do you think that they will need your support in the next few decades?
Yeah. Look, I think that so like a couple of the ones that are really successful, I think an honest answer is they they don't really need us, if that makes sense. Like they're
Yep.
very smart, capable executors. But I think they really like having us because they like having a sounding board. And when you have a sounding board, you usually will lead to a better outcome because you're able to kick the tires and kind of
Mm-hmm.
think through things and have smart people around the table who've maybe been down that road before or seen that turn of the cards. And they can kind of provide really helpful guidance in those situations. And so I think that entrepreneurs who are the smartest use us as a tool in their tool belt and lean on us to provide our perspectives and our expertise. And they check in with us to gut check either their thinking. And I think really good venture capitalists are the folks that kind of take a step back and say, look, I'm not an operator. It's not my business to run. This is your business. You're calling the shots. You're in the driver's seat. I'm here to tell you our preference. I'm here to tell you watch outs. I'm here to tell you things we've seen before or potential gotchas or whatever that may be. But ultimately, it's your business at the end of the day, and you have to be accountable to all the shareholders. And I think that's a venture capitalist really doing their job well, is providing that guidance, but also taking a step back. One of my favorite boards that I have the pleasure of serving on. We've got this like brilliant board member, and he does just that. I've watched him. It's actually informed my own opinion on how to like level up myself and be better, is because he does such a wonderful job of like acknowledging the successes consistently and like celebrating the wins with the team. He does a really good job of being like, it's not just all a party. Like there's some real talk and feedback that you guys need to be given. And then we'll gladly share his perspective, but he always ends his comments with like, this is your business, so you make the decision that's best for you. And it's given that entrepreneur, who is one of the best entrepreneurs that I've ever come across in my entire life, the space to make his own decisions. And he's made some very contrarian decisions, like decided that like, even though he was burning money, this was a handful of years ago and we were heading into the pandemic, that he didn't like the valuation of the round that was coming together. So he said, no, thanks. And it was like, well, where else are you going to get money from? Like your back's against the ropes. I'll be damned if he didn't figure it out. And having the space to make those contrarian calls
Mm-hmm.
has allowed that company to become what it is today. And I think venture, as I said before, is all about being contrarian. So I think your startup founders also need to be contrarian. And I feel like we're doing our jobs as venture capitalists if you're fostering that type of environment and ecosystem. Sometimes the founders are going to be right. Sometimes they're going to be wrong. But it's really, providing the space to allow for that experimentation. And then on the founder too, to like have a short feedback cycle to figure out if something's working and not working, and then be able to pivot.
I think that one of the biggest problem is that when a VC comes in, actually any investor, like I see that so many times.
Yeah.
A founder comes in, giving a pitch, and then of course the investor steps in and you should develop this feature.
Yes.
And this will be great if you do. And the guy is like, that's a vision. I spent like days, hours, years thinking about this.
Yeah.
And now you want me to build your product, which is over there. Like, sure, give me a few $1 million.
I
And
know.
now
It's not
we
funny.
do something. Yeah,
That is actually one of the gripes I have with the ecosystem is there's a lot of egos and there's a lot of people that walk
of
into a
course.
room thinking that they're the smartest ones. I just don't have any patience for that, quite frankly. So I think we're all here to learn and learn from each other. And that's when we're operating at our best is when we're able to do that.
So, this is a great opportunity to ask you the question that
Yeah.
Andy Lerner from IA Capital
Oh,
gave me the
yeah.
best answer so far.
Okay.
So when a startup comes to you and say, "Hey, we are AI off," will you
Yeah.
invest in them?
Yeah, I mean, look, that's people marketing, how they think they need to market. And like we are in a game of marketing. I mean, I say my job is sales. I need to sell my LPs. I need to sell the founders on why to work with
Mm-hmm.
me. Their job is also sales. Founders need to sell VCs on why they should give them their money. I think that AI has become a buzzword. I don't put a lot of credence in it either one way or the other. If you want to say your AI is something great, prove it to me. I'm going to discount that. I'm going to listen to your answer and I'm going to either call baloney or I'm going to lean into your answer and say, oh, actually, I see that that's a huge unlock. And I do believe in the AI story here. So yeah, I mean, you came in this with a tall order. What did Andy Lerner say? What did he tell you?
Oh, so he basically said that InsurTech should not be AI. There are AI companies that are AI companies.
Mm,
However, if you are a AI company that provides services to the insurance company, you should need to know also the insurance. And basically something like that.
makes
I'm most
sense.
likely rephrasing it. But it's more about if you're an insurtech, don't add something that will look that you're doing AI while you
Yeah.
are not really doing AI. Because at the
Yeah.
end of the day, it's decision making with a probability at scale, right?
Yeah.
And we are touching AI and machine learning to
I think
all
they're
kinds
like
of things that are completely related.
so yeah, so to me it's felt like historically there's been delineations between like AI, right? Those were their own
Mm-hmm.
types of companies. But now everything just feels so integrated in where you're using AI tooling and building your platform. Um, and I think that a part of that has been driven by the hype cycle of the
Yep.
VC ecosystem. But I do think that like the other part is a real part, which is I do think there have been some material leaps in kind of LLMs and being able to process them. And the types of AI have truly changed. Like generative AI is very real. And
Mm-hmm.
so to discount that completely would not be accurate. And I believe, I've kind of said this from the start, I think there will be some like pure play infrastructure Gen A that are companies that become massive because they've built, off the tailwinds of generative AI. And they will be in and of themselves Gen AI company or an AI company. But then I think there are other companies out there that they, they're very good at what they are. They know who they are a little bit and they know their strengths and they're going to use generative AI to exploit those strengths and become even better at it. And
Ooh.
so I'm really excited to see that as well. And that's where I really think you're going to kind of see this nice handshake of sorts and why AI will become embedded in a lot of different
No,
companies.
hey, most definitely.
Yeah.
I'm thinking about next, and my sort of if we are talking
Mhm.
about infrastructure, it's more about quantum computing
Yeah.
and how we can see more and more qubits coming into
Yeah.
fruition, and from there, bigger and better calculation, and then
Yeah.
what are the drivers you need, the software, so you can actually do that. But
Yeah.
it's a little bit too early, in my opinion, and they've been developing it for about 20, 30 years now, so
Yeah.
to be determined. Okay, back to the original story, which
Yeah.
is we are in 2023. It's
Yeah.
about to finish Q3 and start Q4. A lot of investors sitting on dry powder and
Yeah.
waiting. I've seen a few deals in insurance and outside of insurance valuation. It will be, or that, oh, you want X, we're going to give you more than X, but we're going to keep the valuation. Or,
Yeah.
well, we're going to give you X, but the valuation is going to be minus mu. Any comments, thoughts, or recommendation to startups who are at that purgatory we are in our 6 or 7 year into the InsurTech journey.
Yeah.
We are usually they will be between A and B, and they need that money.
Yeah. Of course I have thoughts on this. I actually think it's great. Maybe that's a hot take.
You can buy.
Of
You can
course,
buy
I think
cheap.
it's great, right? I'm an investor. I'm getting things for a lot less of a price. But honestly, if I were an entrepreneur, I also think it's great. And this is why. It goes back to that notion we were discussing earlier about discipline. And when you raise at high valuations, like the reason why valuations got so out of control is you have these funds that were raised that were mega funds. They were huge. There was so much money in the ecosystem. And like when you raise an $8 billion fund and you have to deploy that over a 5-year timeline, you have to cut some pretty big checks. I mean, there's not that many companies that like you have to be writing sizable checks. So that's what happened is that like the Tiger Globals of the world were coming in being like, hey, you pre-seed startup, I want to invest in you, but it doesn't make any sense for me to write you a $500K check. I want to write you a $20 million check. Well, those founders are not going to take that much dilution. That's wild. Like, why would they don't need $20 million right now. So to justify them taking $20 million, they were like, oh, we'll just give you this lofty valuation. Well, now you're a pre-seed company. You got $20 million in the bank. What are you going to do with that money? You're just going to start spending it because it's $20 million and you need to put it to work. So the problem is that that's why everybody got over their skis, is like the very boiled down version of what has transpired over the last couple of years. And so those companies that just spent frivolously don't have staying power. And so you want to build, if you're an entrepreneur, you want to build something with staying power. So I actually think this is a really beautiful time in the market where we're resetting. It's not back to the levels that it was in 2015. So it's not like we're at an all-time low. It's still a pretty nice time to be building something. You don't have to give away your business to be able to bring in the money that you need. And be able to get the capital that you need to finance your next couple of years or, journey to your next milestone, without having to give away like even more than like 20-25% of your company. So, but I'm encouraged to see round sizes getting smaller, like pre-seed companies, they just don't need $20 million. So that to me is really
wait. Who received, are you familiar with someone who in the insurance industry that received 20 million?
So
I know 10, but those were like very successful entrepreneur, startup number 3 kind of.
Yeah.
But
one is not coming to the top of my head. I'm sure there's an example of like somebody who's
it's part of the story.
More or less, I was talking about the broader venture ecosystem. Yeah. When we're talking about insurance, I do think so. Here's about the thing about insurance companies, like MGAs and carriers. You actually do need 20 million. That's probably like one of the companies in the ecosystem. I was talking more broadly about like all types of companies. But like there's just so much filings and like all this stuff, operations that you have to have. It's just a heavier burn company. So you actually do need a higher amount of dollars to get an insurance company off the ground, whether in an MGA or a carrier form. So that's probably the exception to the rule, is that those types of companies did deserve to have that type of funding in that case,
20 million, sometimes it's not enough. I had a full conversation with
not enough at all. Yeah.
With a certain, let's go, not a tech entrepreneur, but an insurance entrepreneur who's been doing it for many, many years. And he's like, oh yeah, I need 50 million. And it's like, yeah, but it doesn't come in one. You actually need 10 million for the operation. You need 40. Actually, you need 50 million.
You need some
for
surplus.
The Bermuda entity, for the surplus, for that completely different thing. Totally. Those are two different ways.
You can lever for those, but totally, 100%.
Different investors, different structure, whatever. But what's your attitude toward, we're talking about all those purgatory kind of between the A to B.
Yeah.
Debt financing, can they do that in the meanwhile?
Yeah, I think so. I mean, I definitely think that's on the table. Debt markets are also, experiencing their own challenges right now. And interest rates. Yeah, interest rates all-time highs. So, whether or not the entrepreneur wants to take that on, kind of up to them. But some of my companies have to just like extend their, like they have the line in place because they know, oh, we're going to be able to get to like cash flow break even off of the dollars we've raised, including some of their debt. So I think it is prudent to be able to have a debt line to draw down on.
I think that the more interesting, let's call it part of the reset, it's a reset of valuation and the insane amounts of valuation that we've seen that went to the MGAs and the carriers, which kind of something that you will see for SaaS product, while the multiplier for an MGA is, it should not be 10x or 20x or 30x, right?
Right. So,
exactly. Yeah, that's part of a reset that is actually a very welcoming reset in my opinion.
Right.
Okay, cool. Great. So actually, wow, we passed the 35 minutes mark.
Oh man,
that's amazing.
We've been having fun.
I know that's the whole premise of this kind of InsurTech talk. Okay, so before we jump to the last question, what's next for the fund? What are you looking for? Who should reach out to you? Who should not reach out to you?
Interesting. We're still investing in all things InsurTech. So all insurance founders, you should come reach out to us. We are still very bullish on the space. I think that we have built strong pools of expertise to know what types of business models work, what types don't. I'm really excited to be able to be deploying capital in this environment. So very much open for business and very excited to meet anybody and everybody who wants to come and chat with us. I don't really think folks that shouldn't reach out to us, like people focused on CPG, like we're probably never going to do like a CPG company. But I think we're pretty open-minded when it comes to companies that have tiebacks to insurance. And so if you think that you're building one of those and that exists, we definitely want to talk to you.
Cool. Because I tell you what, I've seen so many things that repeating over and over and over again. Another underwriting platform, another flood model, another, I don't know. Now it's what I like about that now actually, because the industry has been a little bit saturated. So you see more of niche risk coverage. So I love that part. It's starting from whatever that may be, but which is like, that's what the industry needs. And actually population, because they are not covered. And I will take that and apply it to the rest of the economy, the global World Wide Web thingy.
Yeah, totally.
That was a lot of nonsense what I said.
So my point is, even if you're building some sort of redundant underwriting technology that we've all seen a million times, I still want to talk to that person because like maybe there's something new I learned from that conversation or whatnot. So like that's why I will always be hard pressed to tell you like, oh, I'm so jaded over here right now. It's just like, no, I want to see it all. But like my most recent deal was specialty lines commercial insurance, which was something I've been looking for a handful of years, and people are finally going into it. And like the hope is that you kind of accumulate enough of these specialty lines, not to like, they're not a brokerage, so they're not going to ever look like Ryan Specialty, but just that kind of Ryan Specialty flavor where it's like, they started with a bunch of niche lines that they amalgamated together to form this like behemoth in kind of commercial.
I want to meet a guy. Seriously. I want to meet.
Oh, I know.
Listen.
Like brilliant.
I read about him. We talked about him in the past. The guy is like in his 80s. He's still like springing out all kinds of new insurance companies. And you go like,
amazing.
He knows what he's doing.
Yes.
And when you read the S1 and or the S3, you go like, holy shit, there's a lot of money in insurance, if you haven't noticed.
If I knew him, I'd intro you, but unfortunately, I also want to meet him.
Okay, last question that I ask everyone. Give us an advice, something that you will provide yourself at the beginning of your career or to entrepreneurs in the beginning of their career, which is sort of now.
Less of advice. Like I think I've always known this, but I think it's like just really healthy to keep this perspective, which is we're really lucky to be able to do what we do. Like, I'm really lucky to be a venture capitalist. Like, I don't know in what world you get to judge other people's ideas and not have to come up with any of your own. Like, that's just insane to me that that's a job. So I feel really blessed to be able to talk to people all day, every day about their big dreams. And I think sometimes people have talked with enough companies and they get jaded and they kind of lose this, like, they lose the spark that makes it so exciting to be in this ecosystem. And I just think it's a healthful perspective to always just take a step back and be like, this station in life is pretty nice. And the same thing goes for like being an entrepreneur. Like, I think it is really a blessed role in that you've got folks who are betting on you, both from an employee standpoint and investor standpoint. Like, a lot of people are coming around the table to say, we believe in you and we believe in this vision. And like, that's like, what a cool thing to be able to start that at any point in your life. Like, you could be right out of school, or you could be, on the back nine. So yeah, so I just think it's being in tech and especially InsurTech, where I think we're still in the early innings of what is to come here, is really fun.
Amazing. Kate, thank you very, very much for indulging my silly question for the past 40 minutes. It was a pleasure.
It was a total pleasure. The pleasure is all mine.